also broadcasting this over like LinkedIn, the socials and stuff. So we get some good traffic through there as well.
Sweet.
Cool. So it is 11. I'll go and kick us off.
Sweet.
Hey everyone, good morning and welcome back to Financial Literacy Week powered by UMortgage. It is great to see everyone joining us here today. Today we have really a theme day on our Friday, really a lot of like home related courses. So we're glad to have you here. We're glad to kick off our first session of the day doing a first time home buyer course. We're very fortunate to have Sean Grapevine with us, taking us through as an expert on this first time home buyer experience. I'd like to welcome Sean and let you take over. How's it going?
Good, man. Good. Thanks for having me. Yeah, excited to be a part of the first time home buyer course. I was a first time home buyer 5 years after I became a loan officer, maybe like 4 years. So I had an unfair advantage, and honestly, it's still kind of there were parts of it, even as a loan officer, that I didn't really understand that I would have to deal with as part of a client. Home inspections, dealing with real estate agents, all that stuff. I was like kind of a deer in headlights. So my goal today is to kind of lead you guys, everybody, through what first time home buying or just home buying in general is all about. And I think what a lot of resources leave out, in my opinion, is a lot of blogs and like to-do lists and preparation seminars or whatever will they'll get you ready for home buying to the point like you get under contract. They'll teach you how to get pre-approved, which we'll go over later. They'll teach you about like interest rates and principal and interest and homeowners insurance and taxes and all that stuff. Like teach you how to read a loan estimate, all of these things. And then you go under contract and you're like I can't tell you how many people kind of like know the lingo of all of our terms when it comes to loans up until that contract point. And so they'll be like, oh, what are the discount points and fees and stuff like that, which are fantastic questions. And then we go under contract and I'm like, all right, now I'm going to submit your loan to underwriting. People are like, what's underwriting? And I'm like, all right, now we're going to order the appraisal. What's the, like, I knew I had to pay for an appraisal, but like, explain to me, as if I were a person who didn't know what an appraisal is, right? Like all of a sudden, like the glossary of terms just kind of falls off. So we're going to start off with a bunch of that, getting prepared to buy a house thing. And then we're going to talk about what actually happens when you go to buy a house. I will go ahead and share my screen. Who can share? No, it's not. Sweet. Hopefully you guys can see my screen.
Yeah, Sean, you're all good. That's great.
Okay. All right. Sweet. I just want to make sure you guys, I've got a second monitor with like my email pulled up. So I want to make sure you guys couldn't see that. All right. So just for the Zoom presentation, it's pretty straightforward. You can send a chat, use the Q&A feature, and raise your hand. And Ryan will hop on those. You guys can ask questions during. And we'll also have a Q&A session at the end, but you can ask questions during, and he will receive those and interrupt me, and we'll address them. I'll tell you what, though, I'm going to start this slideshow on a different screen. My bad. There we go. All right, can you guys still see it, Ryan?
Yep, you're all good.
Sweet. All right, great. So I'm a licensed loan advisor. I am a loan officer that has been licensed to an MLS system. This is for educational purposes only. I'm not speaking directly to you when I say the word like, oh, and then you're approved. I don't mean you. I mean like the royal you. And in order to make the best financial decision that suits your needs, you should conduct your own research and seek the advice of a licensed financial advisor if necessary. In other words, give me a call off this call if you want some help. This is all put together by our company, UMortgage. I am a branch manager here in Atlanta. Our branch is called ATL Mortgage, and this is all a part of a big, just a push that we have to get people financially illiterate before they undertake something like home ownership rather than after, which is kind of often the case. So, I mean, there have been amazing presentations all week. There's several amazing presentations after this, and this one is specifically for first-time home buyers. If you've already bought a home, or you bought a home like 10 years ago and you've forgotten everything because it's something you really only undertake every once in a while, this is still helpful for you. I think it's probably worth mentioning that first-time home buyer is defined by the agencies, by Fannie Mae and Freddie Mac and FHA and VA and USDA. I think all share the same definition of a first-time home buyer, and that's somebody who has not held ownership interest in a property in the last 3 years. So if you bought a property, if you sold a property 3 years and 1 day ago, you're actually a first-time home buyer. So, yeah, I think the first step is it's important to know everything there is to know about buying a house and all of the qualifications and terms and stuff like that. But you really want to make sure that it is the best move for you. I'm not quite like a Dave Ramsey, but I'm also not like, hey, if your total closing costs are $12,000 and you have $12,001 and like, your new payment's going to be $2,000 and you make $4,000 a month. Like, yeah, you could buy a house. Literally, that's an acceptable scenario to the agencies. But I don't necessarily think that's a great idea. I think like in that case, even if renting is a little bit more expensive on a month-to-month basis, it makes sense to be in a good spot to buy a house. So whatever your expected monthly payment ends up being, $1,200, $1,600, $2,000 a month, $2,400 a month, I think it makes sense to make sure you have all of your down payment saved up, plus whatever closing costs you're going to need to spend at closing, plus at least 3 months of mortgage payments in reserve in case you need them, right? Like chances are you're on it, you have a great job and it's reliable and you don't think you're going to get fired anytime soon. You're not going to get fired anytime soon, but like health things, emergencies, downturns, all of these things can happen at the drop of a hat. And the last thing you want to do is to have just moved into your new house and be struggling to make those payments while you're trying to also figure out, all right, this job situation or this medical situation, how am I going to be how am I going to navigate this? So definitely reserves, right? Mortgage lenders don't, for first-time home buyers buying primary residences, don't require reserves. And that lowers the barrier to home ownership by quite a lot. I think that it's important to have those reserves, and it's nothing crazy. I think in general in life, it's worth having 3 months of housing expense saved up. So in addition to that, like if you regularly contribute to a 401k, and you're like, but I don't have a ton of reserves, like you're contributing $300 or $400 a month to your 401k. It might make sense if you are going to buy a house soon to divert some of that money into like setting up that financial reserve. So it's not necessarily like, all right, well, you need to go get a better job, or you need to go like super skinny on your budget, or I mean, I actually, both those are great ideas. But there's also some to some extent like a just diverting of resources that you can undertake. So I think step one, plan your money. Make sure that like once you buy your house, you're going to be able to afford it, and you're going to be able to afford it in a worst case scenario situation, not in a current case scenario situation. So as part of this planning, right, you want to know what you can afford from a monthly budget point of view. Owning a house that's as nice as the place that you're currently renting can sometimes have a higher monthly payment. And that's fine. Like that doesn't necessarily mean homeownership's more expensive than renting, right? So if you have a $1,500 a month home ownership, right, like a mortgage payment, then $300 or $400 a month of that on day one is going to be going towards your principal. You're actually going to be gaining equity in the house. You're going to be putting it towards your loan. And as you go on, a larger and larger percentage of your payment is going to be going towards principal. So I don't think you necessarily need to go into home ownership being like, all right, I pay $1,200 a month right now. And in Atlanta, I mean, that's great. I don't really know what numbers to use when I'm doing this because like it just depends on the part of the country. In Atlanta, the $1,200 a month is it's like pretty freaking cheap. I know in a lot of places like $1,200 a month would be like a really nice place. In San Francisco, $1,200 a month will get you like laughed out of a building. So yeah, there's a lot, but we're just gonna go with the sort of like national-ish standard for big cities, like $1,200 a month. Say that's your rent. Like a house has a mortgage payment, plus you have to pay your insurance monthly, and then you have to pay your property taxes monthly as well. So you could be looking at a $1,400 or $1,500 a month payment, and you want to make sure that you can absorb that, especially as housing prices are skyrocketing and continue to skyrocket. And also, rent is doing that right alongside housing prices. You want to make sure that you are buying the house that you can stay in for a long time and that fits in your current monthly payment. So monthly payment is one part of it. You want to make sure you can afford it. If you feel like you can afford it, then chances are you actually can afford it. We do some calculations called debt to income calculations, and in my opinion, they're pretty generous for the more strict loans, which we call conventional loans, and then for the somewhat less strict loans, we call it FHA loans. I think they're quite generous, and most people I meet don't have expectations of being able to afford a house that the loan agencies like disagree with. If I went to the average person who didn't qualify for a $2,000 a month house, and I said, "Do you think you qualify for a $2,000 a month house?" They'd be like, "No, absolutely not." But if somebody's like, "Hey, I'm looking for $1,600 a month payment for my house," 98% of the time, unless you just like are not advanced in budgeting at all, right? Like you probably qualify for it. If you have a ton of other debt, you probably don't, and you probably know it. Down payment is the other part, right? So making sure you can you can undertake the monthly payment is huge. A down payment is the second big part of affording a house. Generally, if you can afford the monthly payment, you can afford the down payment, like you're kind of in, and you have a reasonable credit score. So the way a down payment works is essentially that the bank is willing to lend you, or the lender in our case is willing to lend you a certain percentage of the cost of a house. They don't want to be the only ones taking risk. So in general, they need you to put a little bit towards that, especially as a first-time home buyer. There are some cases where you don't have to put anything down. These are called DPA, or down payment assistance programs. We offer those, and in some cases, a down payment assistance program can be a fantastic tool. I think one of the use cases for down payment assistance, right, where you're not putting any money down, is you're just out of college. I met people who are just out of college. Georgia Tech is a big college here, and they go straight into programming. They're making $80,000, $90,000, $100,000 a year, but they just don't have they haven't had any time to set up their savings. But they're not gonna people aren't gonna stop using computers anytime soon. And they're going right into a field that that has a reasonable chance of staying in that field and staying employed and making other payments and stuff like that. Their debt to income ratio is nice and low. It's like, okay, I kind of like these programs, but the issue with these programs is that there's no such thing as free money. So these percentages, right? 3%, that's of the purchase price, 3.5% of the purchase price. If you're going to buy a $300,000 loan, the minimum for typical programs is either $9,000 or, I don't know, whatever 3.5% of 300,000 is, 10,500 maybe. And so this 3% is still getting paid somewhere when you do these down payment assistance programs. And usually how it gets paid is by you over a relatively short amount of time via a much higher interest rate or higher closing costs, or a combination of the two. The cost of the 0% down programs outstrips the costs of the 3% down programs in the course of 6 to 12 months, if not less, just by higher payment, higher interest, higher closing costs, all that stuff. There's always a chance to do something called refinancing out of those later, but that takes into account that hopefully interest rates haven't risen, hopefully property values are like have gone up. Like hopefully you still have the same job, right? You never want to like bank on like, oh, I can just refinance in 9 months. I would never make any decision based off the promise of a future refinance. So all that being said, 0% down programs do exist. I think they're kind of case by case. Don't believe anybody who's like, hey, you really need to do this. I think most people who qualify for a 0% down program can probably save up 3% within 6 months to save themselves a ton of time, a ton of hassle, and a ton of money. The 3% down program, that's for conventional first-time home buyers. So conventional deal is they're put out by these two big government-like companies called Fannie Mae, Freddie Mac. Weird names. And to put 3% down, you have to qualify for a conventional loan, which, like I mentioned earlier, has slightly higher credit standards than the other types of loan we'll mention, which are like FHA loans. 3% down for that, and these conventional loans, they don't have any set minimum credit score requirements, which is super annoying. Sometimes you'll see 660, 680. A lot of it has to do with this automated like approval service that they use. So you're like really not sure until you put in a loan app with a loan officer. But if you have 700 plus credit and a job and a down payment, then the conventional loan program is probably right for you. The other most common minimum down payment is 3.5%. That's with something called an FHA loan. That's a government-sponsored loan. They are actually insuring your loan against the possibility of you defaulting on it sometime. And that 3.5%, the credit standards are a lot lower for FHA than they are for conventional. Some FHA lenders go down to like 550. I think 550 credit score. 580 is like the typical minimum. And then like you see other cutoffs at 600 and 620. I'll go into it later. I honestly like credit score plays a huge part in the cost of your loan. We can get into the whole credit score thing later. So if you have a 580 score or above and you have 3.5% of the sales price saved and you have a job, this is the good news. This is the good news about being a first-time home buyer. This is the good news about buying a house in the United States. I mean, it's the good news for you. Is that if you have a job, a 580 credit score, you don't have a ton of debt, and you have 3.5% of the purchase price of the house that you want to buy, and in your head you're like, I can afford that monthly payment, then like there's a pretty good chance you're approved for a house. Any of those numbers going up, or like any of the credit score numbers like increasing, or your the higher your salary is, or the more down payment you have, any of that stuff just increases your chances. The percentage of people who are qualified for home ownership in the United States is higher than in any other country on earth, and it's also much higher than most people believe. There's probably a 50 million person subset of the population that thinks they're not qualified to buy a home that actually is. Huge asterisk on that 50 million. I just kind of made that number up. Could be 5 million, between 5 and 50 million. Okay, nice tight spread there. Closing costs. All right, when you buy a house, you pay closing costs. There's a lot of moving parts involved in buying a $250,000 piece of real property. Those closing costs are somewhere between 3 to 4% of the loan amount. And that means, and the loan amount is, if you're putting the minimum amount down, it's pretty close to the purchase price, right? If you're buying a $300,000 house, you're putting 3% down. It's a $291,000 loan amount, and 3% of that is still close to that $9,000 range that we gave earlier. Closing costs are reported to you by your loan officer. I'm about to get like a little salty here. That I'm the one who tells you about them. I give you a fee sheet with everybody. I'm just doing my best to estimate the total third-party costs to you, Mr. or Mrs. Borrower. But I'm not responsible for any, but like in our case, maybe like $1,000 of closing costs. We're also telling you like the appraiser that we're going to find on your behalf is $500 to $700. And it costs us $32 to run your credit for you. Other than that, everything on the estimate of closing costs, which is called a loan estimate generally, or like a fee sheet or fee estimate, is our reporting of third parties. And there's just a ton of third parties involved. There's the closing attorney, well, in Georgia anyway, the title agent in other states. So you pay them to help you close the loan. You get something called title insurance. You pay the county a certain amount to record the mortgage. You pay the county a certain amount in like property taxes. You pay the state a certain amount in property taxes. In Georgia, we have something called the intangible tax, which is like the highest tax you'll ever pay. It's not intangible at all. They should call it the tangible tax. And that's a sales tax on your mortgage. Sucks. There's something called owner's title insurance. You have to pay your homeowner's insurance agent right at closing. So there's a lot of moving parts, and a lot of these are somewhat like shoppable and negotiable. Your loan officer should help you do that with referrals to real estate closers and like title agents and to homeowners insurance agents and stuff like that. But I would expect 3 to 4% of the loan amount. If you're buying a condo, it could be higher. If you're buying in some states, it could be a lot lower, but this would be a good number to prepare for. There's other costs. Okay. Other costs are like ones that I really didn't expect, even as a first-time home buyer who'd owned my own mortgage brokerage for 5 years. I kind of like had thought it through a few times, but was pretty surprised at how much cash out of pocket was required during the process. It wasn't like it didn't break the bank, but I was like, oof, this hurts. So you need to get the home inspected by a licensed inspector, not your parents. I mean, unless one of your parents is a licensed inspector, get it inspected by a licensed inspector. They're going to give you a 27-page report at the end of like everything about the home. Don't let the length of it scare you. They're all 27 pages, whether you're buying like a shack or a perfect mansion. But the inspector costs maybe $300 to $600 depending on where you are. Maybe as low as $200, maybe as much as $700. And then there are other things too. Like you might want to get a radon test. Some inspectors have that included in their fee, but like it's an important thing to get tested. Radon is responsible for the second most amount of lung cancer cases in the United States. And that's just behind smoking, right? So like as far as natural causes go, radon is an important thing to check for, right? And like the home inspector is also looking like, is the roof going to be okay? Do you want to like it's $400 or $600 or $800? It is a small price to pay to not buy a house where you're going to owe $15,000 on week 2 of owning it. So home inspection is huge. Let's see, what else did we have to pay? There's one other like fee I was like kind of surprised about, but I would say like plan for $500 to $1,000 of like additional fees going in, right? You might need a survey, which costs money as well. We didn't get a survey, so I hope that we own the land that our house is on. All right, finding a lender. Okay, so step 1 is to text me 770. No, I'm just kidding. There are 2 things. There are only 2 things that you have to think about when finding a lender, more or less, is their level of expertise and their cost. Mortgages are something you have for 30 years after you get them. And the pain of doing one with somebody who's like a pain is like, if they get it done, like that's fleeting, and an ultra high interest rate is not fleeting. They call these fixed rate mortgages for a reason. And so you definitely don't want to give your money month after month after month to a lender because a loan officer overcharged. Cost is an important part of finding a lender. Expertise, I would argue, is the more important part, because you can't afford to go with a loan officer that gets 96% of their loans from contract to closing. If they do 100 loans a year, that means 4 people per year are in some level of like dire straits because they made all right. Like we've rescued deals where somebody's like in a U-Haul from Virginia with their cat. This is a very specific example. Driving to the house that they think they're about to close on, and they just got told by their loan officer, like, hey, this isn't going to happen. And sometimes we get those calls and we're like, oh, this is an easy fix. This person's an idiot and we'll get this fixed up. Give us 10 days. We'll get you closed. Other times you're like, wow, I can't believe that person didn't see that on day one. There's nothing we can do to help you. So you just never want to put a person in that situation. So being a mortgage loan officer requires 100% or like near 100% close rates. So you might see like, I'll try not to throw any of our giant online bank competitors under the bus. You might see like a giant, really well-known lender that's on Google, and they've got their 4.2 stars out of 5, and you're like, that's pretty good for a financial services team. Like, all right, 4.2 out of 5 is the same as 84%, right? That's it would be like having 8.4 stars out of 10 or 84 out of 100. That means that 16 out of 100 people like experience some level of like they could have done this better. Now maybe it's just they got a bunch of 4 stars. They're like, they did a pretty good job, but like they weren't cool enough. But if you go and you take a look, the number of 1-star reviews are just like that. A 1-star review on a mortgage website is like person after person after person after person being like, and I thought I could get into a house and I couldn't. I thought I could, but I couldn't. And not only was it like I called and then they just told me that I couldn't. That's fine. It was like I called, we went under contract, we filled out a loan application, we ordered an appraisal, we paid $1,000 for inspections, we paid $600 for an appraisal, and then come closing day, they said that we couldn't in fact close. So finding a lender is huge. There's a lot of really great resources for finding good ones. Look online for lenders that have like 4.99 stars out of 5. Ask local real estate agents who their favorite lenders are. And then just call around and chat with people who sound like experts. And if you have any misgivings at all, just be like, I'm going to move on to somebody that I know is going to close me. So the advantage of UMortgage, the company that I'm currently with, and I closed up shop on my own mortgage brokerage to come work with UMortgage. And the reason I did that is because they have the best of both worlds. Crazy level of expertise, crazy level of like operational standards, like that. Nobody is faster. And then also they offer the pricing that I was able to offer as a small broker, and we're a much bigger company. So there is the best of both worlds. It's like the only industry in the world where you can actually have better, like best, fastest, and cheapest all at the same time. They say that you can usually only pick 2 of those. But in this case, you can definitely pick all 3. So anyway, that's my one like little pitch for UMortgage. There are plenty of great lenders like UMortgage out there, or almost as good as UMortgage, and a lot of them are our friends and colleagues, and we totally support that. If you want a referral, literally just contact somebody at UMortgage, and if we're a good fit, we'll be like, this is our offer. If we're not, we're happy to point you in the right direction. We want everybody to succeed in the industry, and we want every potential customer to have a great experience with the industry. So,
quick question that came
sure.
into me here. Somebody asked, like, what is the difference between someone like you and UMortgage and someone like a Rocket, or like someone they see advertised on television like that?
Yeah, I mean, that's a great question. There's so many different answers. I would say, like, going back to the expertise and cost point of view, like, because you said their name and not me, right? Like a competing offer from Rocket on like a standard $400,000 house is going to have, for the same interest rate, probably $8,000 more in closing costs than ours will, or than like any reasonable lender is going to, right? We're not alone in like, we're not just like out there to undercut Rocket. Literally, like every mortgage broker is out there to undercut Rocket. So cost is a big one, and then you have to think like expertise wise, right? They hire like most of their loan officers are just like call center loan officers. And so the level of expertise, right? Like I owned my own mortgage brokerage. Now I'm the branch manager of Georgia and like the surrounding area. And like I live or die by whether or not my clients get into a house. Like every single loan that happens in this, like in my state, I am like watching and looking at every day. So I think there's a level of ownership that like kind of gets lost in some of those bigger companies. I mean, the other thing too is like you got to realize like we make money every time we close a loan for a client, and so does Rocket. I mean, I have no problem admitting it. That is what happens. That is how we get compensated. We get compensated by our lenders, not our clients, but we get compensated for doing it. And if you are buying a Super Bowl commercial, then like some of the money that you are paying to that company is going to things like this, like crazy marketing. I mean, I don't think it costs us anything to do financial literacy week. Like this is like a service you, right? Like this is the airtime for this versus like Super Bowl, or like the cost is significantly less. So I just always get weirded out when I see like big companies who are like, we save you money. Let me spend like $30 million on this 30-second segment. So I think the big thing is cost and expertise, like I mentioned earlier. And go look at their reviews. I mean, they may have 4+ stars on Google, but like it just doesn't really cut it in mortgages. And then just get a quote from them. I don't think it takes very long. I'm sure they have like an automated process for it. And then bring it to literally any mortgage broker or correspondent lender or local lender in your area and be like, can you beat this? And like all they have to do is read the top right part of the estimate, and they're like, yeah, I'm pretty sure I can. Like I'm gonna save you so much. I look so good when people bring me Rocket loan estimates. And this goes for any giant lender, right? Like any of these big banks. Like a big bank, like they're worried about checkings, savings, CDs. They're worried about investments. Like they don't invest a ton into the expertise of their loan origination crew. And so like I would just say like go with a company that's like, I service this area super well, and all I do is mortgages. If somebody was like, hey, do you have a checking account? I'd be like, yeah, send me a check. I'll keep it for you. Don't worry. But like, we don't have any other products. That's all we do. It's just mortgages. I hope that answer your question. You think, Ryan?
Yeah, I think we're good. That sounded like a great answer. Thanks for taking care of that question.
Sweet. Yes. Next up, real estate agents. I love real estate agents, and I got into the business being like, I'm just going to admit it. Okay. If any of my real estate agent friends see this, I don't think this anymore. I got in thinking like 3% seems like a lot to charge for just like carting people around in your car to see houses. Like I'm making a way less than that per deal. And doesn't really seem like that hard of a deal of a job. And I just don't understand what's so important. And so I would recommend like discount brokerages and stuff like that. And now that I'm a loan officer, I cannot tell you how important having a good real estate agent on your side is. So for so many reasons. First of all, they're like your deal concierge. Like, don't forget, you're going under contract on a $500,000 property. I've tried to sell like a business for $500,000 before. It takes like 9 months. It's like, and it didn't even work. Like it's the only $500,000 deal you'll ever go through in your entire life. I mean, that statement alone might be true, right? It might just be the only one, but it's the only one that you'll go through that you can like finish up in 15 days usually. All right, that was easy. And to have somebody who's an expert at navigating that journey is super important. And I'll tell you exactly how I know this, because we have clients all the time that don't have a buyer's agent, which I cannot understand why you wouldn't do that, because the seller is the one who pays them, and then the buyers invariably don't have a listing agent, which I kind of understand from a cost perspective, but it's very annoying from a loan officer perspective, because you know who ends up becoming the real estate agent in these deals is me. And you know who's unqualified to become the real? I mean, like I don't get a commission for it, and nobody acknowledges that this is happening, but it's true nonetheless. And it's a disaster. Like I'm like, hey, can you sign this thing on this like addendum to your contract? And then I like send it into the closing attorney, and they're like, no, you told them to sign where the buy. And it's like, you need somebody who's going to be an expert in this. So not only in just like concierging the journey of like going from contracts to closing, but also making sure that you're getting the best deal and the best terms possible on your deal. A great real estate agent is going to be intimately familiar with what is aggressive enough to offer on a contract without, forgive me for saying it, screwing you, right? Like, yeah. And these days, nobody's taking less than they list a house for the most part. But I also see a lot of offers going out for $50,000 over list that probably would have won at $20,000 over list. And so you have maybe like a lazy agent who's just like, well, we got to win this, but like not really taking into account what the actual market is, or they're putting 0-day, due diligence, which means you don't have any days to inspect the house. They're telling the client like, that's the only way we can get it won, but I'm getting other offers that have 3 days or 2 days or 4 days of due diligence. Like it's important to get as good of a real estate agent as you do lender. I think it's harder to find a good real estate agent because the metrics are different than it is to find a good lender. And I think it's definitely worth talking to people that you know that had a great experience. I think that's the best way to figure it out. If somebody's great on just one transaction, they're probably great on all their transactions. So yeah, shop around. I don't think you should shop for price if you're buying a house. The seller pays the real estate agent, and like the last thing you need is, on your third house, fine. Maybe you're an expert, but like the last thing you need is somebody who's offering you 50% of the value for 50% of the cost. Getting pre-approved. All right. Getting pre-approved it's a simple process. I went over it kind of earlier. And I'll go into it in a little more detail here. It's really quite simple. We look at 4 or 5 things when it comes to lending. We look at how much money do you make? What are your current monthly debts? What is the percentage of those two to each other? What's your credit score? Do you have a down payment, and where is it coming from? And are you who you say you are? Right? Those are the big things. So generally, we just request, after you fill out the loan application, we request pay stubs, W-2s. We take a look at your credit report. We take a look at your bank statements, and we take a look at your identification. And literally, if you have a job, like a regular job, if you have variable pay, it can be harder to get a mortgage unless you've had that same variable pay, like same job, getting variable pay for 2 years. If you were a full-time worker, whether hourly or salary, you have a manageable amount of debt. I'm not saying no debt, like have a car payment. Work those credit card reward points. Yeah, obviously student loans are like an important part of getting an education in the States. But if you don't feel like you're buried in debt, then you're probably fine. If your credit score is like, if you feel like it's good, if you make all your payments, and if you have that 3% or 3.5% down payment, like you're literally who the American mortgage system is made for. It's really not that hard. All of the other stuff we request, all of the documents, stuff like that, is just like, oh, you said you make $5,000 a month. All right, cool. We just want to take a look at a couple of pay stubs and W-2s. Oh, you say you have $10,000 in your bank account? All right, sweet. We just need a copy of your bank statements. So all of the documentation just goes to verifying all of the stuff that you said on your loan application. A loan application is super easy to fill out. If you go to umortgage.com/apply, you can have one filled out in like 15 minutes. Maybe less. It's super simple, step through. If anybody's trying to get you to fill out like a paper one, or just don't do that. Red flag for a mortgage lender. And you can get it filled out super quickly. And if you have a pretty like vanilla, we call it like a pretty plain or like easy, right? Like you have like a regular job, regular credit score, regular amount of money, like any of these, then getting pre-approved is generally something I would recommend only getting done with 1 or 2 lenders. Every time you get pre-approved, they pull your credit. And I think the risk of credit inquiries is overblown to your credit score. But I also don't think that, like, here's the deal. Here's the dirty little industry secret. If you're approved for an FHA loan and your score is above 620, and if you're approved for a conventional loan with one lender, you're actually approved with all of them. We all underwrite off of basically the same guidelines. That's not entirely true with like some of the big banks that have these like weird, what we call overlays, like different restrictions on top of the guidelines that are actually put out. But all that being said, like don't go spamming your loan application ever. If you want to get rate quotes and fee estimates from lenders, you don't have to get pre-approved to them, no matter what they tell you. All they need is like the scenario of the house you want to buy and what you say your credit score is. If it comes out later that your credit score is different, obviously your rates and fees are subject to change. But you could definitely get competing quotes without like, sometimes I just get borrowers that have like 10 credit inquiries. And I'm like, oh, you went through so much extra work to like hear that you're pre-approved from everybody. Don't worry about that. Get pre-approved with somebody that you trust. And, as long as you're not sort of like a more complex loan, this could be the case with like, if you're self-employed or if your credit's lower or something like that, or you're getting your money for the down payment from like various different sources or any of those things. you may want to get pre-approved with multiple people just to make sure. But if any of those things aren't the case, get pre-approved. Just reach out to the loan officer that you trust, get pre-approved with them, and then you can shop between other lenders basically with that pre-approval. Like, hey, it says my credit score is 717 and we want to buy a $300,000 house. We're putting 3% down. Would like send us a rate quote for that day. What's the point of getting pre-approved? Well, you want to be approved prior to going under contract. You actually, I mean, whatever the point is that you just have to do it. I don't know of any listing agent in the entire country right now that's accepting offers from clients that are like, yeah, and then I'll get a pre-approval. Getting pre-approved literally means like, I've had an expert look at my credit, my income, my assets, my loan application, my debts, and all of that stuff put together, and who I am, and has compared that against the guidelines that we have, that all of us share, to make sure that I actually fit into that really large bucket of like who's approved. Once you're pre-approved, you can feel like you also find out how much you're approved for, more or less. It's usually given as a range, and most people's budget is lower than their pre-approval amount. But you do want to know what like your upper limit is. You don't want to be putting on offers on a $350,000 house if you're only qualified for a $300,000 house. Loan types, we've kind of been over them. There's conventional FHA, or the normal ones. If you're a veteran, then there's VA loans. They're the best loans on the planet. It's worth serving in the United States military to have access to the VA loan. Honestly, 0% down, no PMI, which is like mortgage insurance. We haven't been over it yet, but it's like a extra $100, $200 a month that you pay on conventional and FHA loans. Like, being a veteran, it is the best benefit. Well, I don't know if it's the best benefit. I'm not a veteran, but it is an incredible benefit that we offer to our veterans. The underwriting is like it has a lower minimum credit score, has higher debt to income ratio that it allows. So if you're a veteran, get a VA loan. I mean, they're fantastic. The rates on those are 1% lower than competing loans. So you've got conventional, which is like slightly higher credit requirements, FHA, slightly lower credit requirements, VA, and all first-time home buyers and second-time home buyers alike can use all of these. There's USDA if you live in a part of the country that is considered rural. You do have access to those. It has some like income restrictions. You can't make too much money for a USDA loan. And that can be a little bit limiting. But what's not limiting about it is how many areas of the country are considered rural. Like I'm here in Atlanta, and like I think I would have to drive like 7 miles to get to a place that qualifies for USDA loans. So it's definitely worth taking a look at. Those are the main ones. There's also jumbo loan. Conventional loans and FHA loans actually have maximum loan limits. So we don't see a whole lot of first-time home buyers jumping into jumbo loans, but a jumbo loan is any loan amount over $600,000 to $900,000. Max purchase price is what a pre-approval gives you. Interest rate, a pre-approval will give you like an interest rate range or specific interest rate, but it would only be like for that specific day. And interest rates are changing like not even every day anymore. Like every hour or two, we get some reprice notifications that interest rates have gone up or down or sideways or don't exist anymore, do exist now. It's crazy out there right now. It's a very volatile time in the market. So you want to make sure you keep an eye on those rates while you're pre-approved. Down payment, right? So getting pre-approved will let you know your like specific down payment amount. Lender costs, hopefully you'll get a fee sheet or a rate quote or a loan estimate with your pre-approval, and it should give you like your lender costs and estimated costs. Application, credit pull. So this is getting docs ready on the front end. You're gonna have to expect to put in an application. Yeah, it should take 15 minutes. Credit pull. Yeah, like I said, don't go everywhere, but you do have some leeway in terms of getting your credit pulled. You're gonna want to send the documents that your lender requests, receive the pre-approval letter, also ask for an estimate, and then go shopping. Comparing loan officers, we kind of went over this already. Look for an expert, cost matters, but not as much as expertise. That's what I said. Here's some don'ts to do while being pre-approved or getting pre-approved. Don't make a major purchase. Actually, you can run it by your loan officer first. If it requires opening a new line of credit, you probably shouldn't. If it's not going to hurt your down payment or closing costs, you know what? Just run it by an expert. Just ask your loan officer. Don't make any late payments. Don't quit or change your jobs. And again, this isn't like, don't do that. Like, just be like, hey, is this going to, I mean, obviously, if you're going to get a job that's going to pay you more, then even if it does hurt your chances of getting approved right now on a house, like, definitely take the life-changing job offer. Just make sure that you tell your loan officer about it, like, before you go under contract. And then making large deposits or withdrawals from your account. Again, you can do it. Just make sure that you run it by the loan officer. If you're taking about a bunch of cash from out under your mattress and putting it in the bank, like, we're not able to use cash deposits towards your assets as loan officer. You want to make sure that you're doing it the right way. Finding a real estate agent. Kind of went over this. I think a dual agent is like if somebody's representing you and the seller. And how this ends up happening 99% of the time is if you don't have a real estate agent, you go to an open house, the listing agent for that house is there, and you say, I want to buy this house. And they say, great, I'll represent you as well. And you just can't, like, I think it's very difficult for a real estate agent to represent both sides of that transaction with the same, like, responsibility to the parties that is necessary. I know actually a ton of agents who would be fantastic at doing that. Don't get me wrong. I just think your chances of finding one of those fantastic agents at an open house, like, make sure you're going out there with an agent and that you have somebody who's willing to represent you and only you. Gauging agent responses. Just, make sure they're answering you in a timely manner. Always look for helpful agents. As far as shopping for homes go, your real estate agent, if you pick a great one, like a full service with a great brokerage or their own brokerage or something like that, they're going to help you out so much. Stick to your lender's price limits, stick to your monthly budget. And you can always find out, like, hey, is this house in my monthly budget? Here's the thing, like, a $300,000 condo might have the same monthly payment as a $400,000 house because of its, like, $500 a month HOA. So make sure you're running each property that you're pretty interested in by your lender. You're not going to annoy me by sending me 3 properties a week to be like, hey, is this, like, what's the monthly payment on this house today? Like, that's our entire job. People are always like, oh, sorry. I'm like, no. This is great. Send it over. I want to make sure you make the right decision.
Hey, Sean, a question came in. Sorry for interrupting you.
Yeah.
A question that came in. So are interest rates ever locked in, or can they change until closing is completed? You talked about how they're changing all the time right now. So how does that work?
Fantastic question. So in general, there's a few answers to that question. I would say 95% of the time with us, when you go under, the day you go under contract, we're going to lock in your rate at that day's interest rate, right? Like, if I knew what direction interest rates were going to go, I wouldn't be a loan officer. I would be that Wolf of Wall Street, honestly. So I would say, like, if you like it, then just get it locked in. There are some times where you might want to lock an interest rate in before you even find a house. That's called like a lock-in shop. They cost a little bit more money sometimes. And also it's like, they make more sense now than ever because I'm pretty sure interest rates are going to keep going up, but there definitely is a cost, right? No lenders are offering these, like, for free, right? There is a cost. So you could do the lock and shop. Some people choose to do something called floating their rate lock. I don't even like give this as an option to my customers, because what ends up happening is, especially in a rising rate environment, you go under contract and you're like, oh, I think interest rates might go down. I'm going to float it. And and that just means not locking. They go up the next day. They go up the next day. They go up the next day. And then all of a sudden, like, this person who definitely could afford this house, like, can't or doesn't want to anymore. And I just say, like, if you can afford it on the day you go under contract, you just lock that sucker in. So 95% of the time you're just locking on the date. And then that lock is good until closing. Generally, if you have to extend closing, you might have to extend the lock for a small amount of money. But yeah, generally, once you go under contract, your interest rate is locked until you close. And then once you close, it's locked forever for 30 years.
Great. Thanks for taking care of that, Sean.
Yeah. Did a hand go up?
Apparently didn't see anything, but yeah, I mean, keep those questions coming if you have any.
Yeah. So writing an offer, this is something you do with your agent and also with your loan officer, right? So there are 3 parts. There are 3. I think there's like 4. The 4 biggest parts of an offer for a house are the cost of the house, like the price you're willing to pay for it. And that's important, but that really only gets you like 60 to 70% of the way there. It's also the closing date, right? Like, can you do this fast enough that the seller wants to take it, right? If you're offering $50,000 more than somebody else, but you're like, but we want to close in September, they're not going to take your offer. So being able to close quickly is important, and having a great, like the big banks are like, oh, we can close in 45 days. Nobody's going to accept that offer. Not these days, unless you find somebody who's like, I don't want to move for 45 days. But usually it's like, you want to be able to get this done like 15 to 25 days if possible, or at least show off to the seller that you're capable of it. And if they're like, we only need 40, you're like, oh, okay, perfect. Now we can take our time. Closing date. There's also like in Georgia, these all have different names in different states, but like we also have a financing contingency, which is like how long you're allowed to pull out of the deal for if the bank ends up declining your offer. First of all, you're never going to go under contract on a house with a pre-approval from us and get declined. Just doesn't happen, right? Like we have to have that 100% success rate. But the sellers don't know that. And you really want to make sure that you are doing a nice, quick, or 0-day financing contingency. The other part of that is the appraisal contingency. You're allowed to back out of a deal if the house comes in under the value of the purchase price upon like ordering an appraisal, which we haven't talked enough about, honestly. But you're allowed to back out of that deal if the appraisal comes in short within this time period. Back in the day, like it was impressive when we could do it in 17 days. And back in the day, I'm not talking about like 2016, it's like 6 years ago. Now, like competitive is 11 days, fast is 8 days. And we have such a great panel of appraisers that we're putting 5 days to make sure that like our customers get their offers accepted. We don't want us standing in the way of an offer being accepted. The only thing we want standing in the way of it is price, right? Like that's up to you and your agent. The rest of it is make sure you're working hand in hand with your agent and your loan officer to like zero in on the absolute finest and most aggressive contingencies and dates and timelines that you possibly can. You used to be able to ask sellers for things on houses. I mean, you still should, right? Like don't buy a house that has water damage if they're not willing to fix it. But just so you know, it's much more competitive market out there. Sellers can cover closing costs for you as well. If you find something that's wrong with the house that they don't necessarily want to fix before you close, they might say, hey, well, it's $3,000 to repair these windows. What if we just cover $3,000 of your closing costs? So that's a very typical way to sort of monetize the issues you find with the house upon inspection, renegotiate the terms of the deal, and make sure you're getting what you want and need. The seller can either say, we don't want it, or they can counter offer you. Once everybody agrees to the deal, you have a binding contract. So fun. And you just want to make binding contract means like you're under contract. You can't pull out of it for anything other than like the things listed in the deal, right? During due diligence, you can pull out for various reasons. During the financing contingency, you can pull out if your loan's declined. And during the appraisal contingency, you can pull out if your appraisal comes in low. Otherwise, you're locked in. The seller is like more than locked in. They don't have any recourse for pulling out. We kind of went over offers that help you win: quick closing, quick appraisal, quick financing, and like, a competitive sales price. Offer letters are enduring some level of like, they're basically like, hey, here's a picture of like me and my spouse and my dog. Like we'd really love to buy your house because we're not like a evil hedge fund, and we're trying to start a family here. It's sort of like a way of like winning over the seller. I think these work. There's some level of like discontent. People have mentioned like, wow, it seems like this is a good way for sellers to like sort of discriminate amongst their buyers. Anyway, you should look it up. There's some really interesting conversations happening around offer letters. I think these days the best offer you can make is going to be price, quick close, quick turn times, and just having a super aggressive offer. Calling the listing agent is something a great loan officer should do. So when you have a loan officer, you go under, or you make an offer and you say, hey, loan officer, will you call the listing agent and tell them how well qualified we are? And I'll just pick up the phone and be like, hey, listen, listing agent, these people are the most well qualified buyers I've ever seen in my entire life. They have low debt to income, high salaries. They're not going to give away any of your information. They are going to put you in the best light to get this deal won. Because guess what? That loan officer doesn't get paid unless you get this house. So they have every reason to just show off your finest traits without giving away any of your personal information. Home inspections, we went over. Here's the takeaway. Do them with the certified inspector. And then the underwriting process. So if you have a great loan officer, we're kind of getting to the end here. And this is like, we got to the first time home buyer, like pre-contract stage. And then I told you I was going to tell you everything about the underwriting process. And it's 11:54 somehow. For underwriting. Underwriting is basically the lender themselves, or the within the transaction itself, everything that your loan officer's already verified, being re-verified under a microscope. And with a great loan officer, you won't feel a thing. It'll be the exact same, right? Like all that needs to happen is like, we pre-approved you for just like any old house. Now that you have an actual house, we need to make sure that like we get title back. Title means like that the person selling it is allowed to be selling. We need to get an appraisal. We need to make sure that the price you're paying for it is supported by the actual value of the home. We need to get homeowners insurance on this specific house that is compliant with all of the various guidelines. So like there's all these like very property specific things that need to happen that you just can't do ahead of time. But the underwriting process is just re-verifying everything the loan officer has done and making it apply to a certain property. And so much of that is done. If your loan officer's done a great job, so much of it is done ahead of time that all that's happening is like, get your loan in there, send in all your signatures, we send in your contracts, and then a bunch of third parties go to work. We get the title officer doing their work, we get the insurance company doing their work, we get the appraisal company doing their work. We've got all the stuff that you've already provided us. We put it together in a package after about a week of waiting around for these third parties, and we hand it to the underwriter and we say, all right, we good? And with the great loan officer, it should really only take a week to 10 days. And the underwriter says, yeah, we're good. And then you get to the closing date, and essentially the lender sends the money to the seller for how much you're getting financed. They are confirming your ability to repay, right? That's like your monthly payment plus your current debts against your income. They're communicating with the loan officer and essentially like dealing with the title company and HOI's homeowners insurance. Appraisals kind of already been over. Appraisals, the lender just absolutely has to be assured that the house that you're buying is worth the amount that you're paying for it. If it's not, then you have to cover the difference because it puts the lender at great risk. Appraisals are a huge pain point in the industry because of the increase in value, like month over month right now. So it's definitely worth going to a lender or loan officer that when you call them, you say, hey, do you use a panel of your own appraisers? Like, do you have expert appraisers on staff that are specifically going to work in this area? And if they're like, nah, we just kind of farm it out, don't go with them. Go with somebody who's like, yeah, I know exactly who's going to appraise, or like exactly what group of people is going to appraise what area, and I have utter trust in them. At closing, it's just everybody sending their money to one place. You send your down payment to the title company. The lender sends your loan to the title company. And the title company basically divvies that up between the seller, the real estate agents, all of that stuff. And you sign 1,000 papers, one of which is the deed going from the seller to you. And at the end of it all the money's changed hands, the deed has changed hands, and you're a homeowner. And you're clear to close. So you've closed. Man, I went a little over, but I'm happy to answer any questions anybody has off this. There's probably about like 4% of the very end of the transaction that I missed. If you have any questions, feel free to email me at sgrapevine@umortgage.com. I know we're a little short on time for questions. Does anybody have any questions? Nope, no questions. All right, Brian, no questions?
No, didn't see any questions pop up, but like Sean mentioned, sgrapevine@umortgage.com. You can also visit our website and find his contact information and a way to reach out if you do have any questions that pop up. Just to wrap things up here first, I want to thank Sean giving his time here to go through the first time home buyer course. Really appreciate him taking some time out of his day, and we hope you gained a lot being here and being part of this experience. I want to thank everybody who showed up as well. If you're someone who's like, hey, my partner, that would have been a good course for them to watch, or like watch this webinar, they can still, you can pass the registration to them, sign them up. We're going to be running replays all this weekend. So if you know somebody who could benefit from this course that Sean just gave, they didn't miss out. They can still catch it this weekend if they'd like to see it. We have a lot of great sessions coming up today. We have our next one happening in just a half hour at 12:30 Eastern Standard Time. We're going to be doing a second-time home buyers course. So for those people who own a home and are looking at maybe, I'm ready to move, I'm ready to look for that long-term home or second home. So we're going to go through and do a course on that coming up in just a half hour. So one last thank you to everyone who joined us. Thank you, Sean. Take care, everyone, and we hope to see you soon.
Thanks, guys. Have a great day, everyone.